Good morning and good afternoon, depending on where you are. Mudit, over to you.
Hi, very good afternoon. Thanks, Pradeep. Welcome to the elite customers of BBK NRI, both from Bahrain and Kuwait, whosoever there be. My colleagues from different parts of India who are into this business and their customers therein. Warm welcome from BBK NRI to all of you. It's a Saturday. I understand you all must be at home, but thanks for joining it and welcome again. So shortly, we know that you all are equity investors for a pretty long time, and as an equity investor, what I understand, we always look for kind of market, whether it is on top or low or whatever is the economic or economic conditions in country. There is always lies some opportunities. Only thing we know, what we require is knowledge to understand and to make out that what are the opportunities lied in the market. So the situation today, as we know, that the last 1 year has been quite eventful, I would say, because if we recall that the market started correcting post-COVID wave last year, and in the mid of the year, the market started moving up so and so that it does the new peak. So the last 1 year, few have lost money, if you have made money. But those who stay invested had definitely made money, which is the most important thing which we want to disseminate this time. So as I mentioned, when we want to have the knowledge part, we need experts from the industry. You have been getting our mails and our recommendations and our thoughts on the Indian economy or Indian market or Indian funds. But as a BBK NRI, we always believe to introduce you to the experts of the industry so that you yourself can understand, you yourself can listen to them, share their thoughts. And of course, at the end of the session, you can raise the queries and questions so that you can get the satisfactory reply. So, as I was mentioning, in last 1 year, a lot of things have happened. Whether we are into we have got the change fundamentals, whether because of the second wave, there would be some delay in growth or the earning recovery.
Sorry, Mudit, you have gone on mute.
Yeah, some host has gone. Okay. So sorry, I don't know where I got to stop, but what I was mentioning that since the last 1 year was quite eventful. And so in that background, we have to see that how are the fundamentals right now, whether the second wave has changed the sector outlook for the certain sectors, which were looking good last year, which the other sectors might have emerged well for the next year, because what we'll have to see that what are the sectors hence for next 1 or 2 or 3 years, which are likely to do well compared to the other sectors of the economy. And that we have to identify earlier and enter into those sectors or those funds so that will be benefit of the market. Now, this all has to be into the background of the overall macroeconomic conditions of Indian economy. So what we thought that let us bring forward experts of the industry so that we can listen to them and the based of the knowledge which they impart, we would be able to strategize our investment options. So when it comes to expert, we as a BBK NRI, we always believe getting associated with the fund houses who have got at least these three characteristics or qualities. So one, we always look for who are the sponsors of the fund. So you know that India is having almost 30 plus AMCs. And it is not that we tie up or we get associated with each and every of them. So as you see that the Union Mutual Fund, the sponsors are Union Bank of India, which is still well comfortable with the patronage and the sponsorship of Union Bank, which is now a bigger bank post-merger of Corporation and Andhra Bank. So once we are comfortable, it's a selection process for us also. And then once we are comfortable with the sponsor, which is the crux of any AMC, then we see who are the persons, who are the managers, what is the management team who are managing them. And I'm happy to share the management team which manages the helm and who are into helm of affairs of Union Mutual Fund are well known to the industry, well reputed. Shortly, I'll introduce them to you. And so when we thought that the management team comprises of CIO, I'm in the major, the main team of the fund. If their credentials are better, if we are happy with their performances, and then we take them into our in the tie-up. And third is, of course, which is the important thing, is how the funds are performing. Of course, which is more important for all of us. So in that context, when we see that the three criteria which internally we have formed are duly met by the well-known Union Mutual Fund, we thought why not get associated with them. And out of many funds, we are looking three top funds, which like the Flexi Fund and Mid Cap and Small Cap, which were looking very aggressively. Of course, there are other funds also which have been doing well. Introduce without wasting much of time. G. Pradeep Kumar is the CEO of the Union Mutual Fund, and I am graduate. He has been into Union Mutual Fund for last 11 years, and to be honest, I know him for last 35 years, which gives me more comfort about associating with this fund house. I know that with his capabilities, capacities, aggressiveness, activeness, knowledge, experience, he is driving, has been driving, and will continue to drive this fund house to the newer levels, which has been happening, we have seen in the past as well. So thank you very much, Pradeep, joining us. We have the next important person, as far as our tie-up is concerned, is the Chief Investment Officer, who decides the strategy of a particular fund. And there also we have analyzed the credentials of the CIO, who is Vinay Paharia. He has got 18 years of industry experience. Now, experience all the fund managers have. But what we look is what actually he gave to the industry. And when we see that his funds have been ranked among top quartile, he has got the fourth best fund house from Outlook in 2020, sixth in 2019, and 2018, 2016. So we believe the external agencies evaluating a fund manager rather than we doing from the performance may go up and down, but this Outlook magazine and the external agencies, when they evaluate a particular person or the performance of a fund, that gives us more comfort. So I'm happy to share that Vinay's managed funds have been ranked on the top ranks all over. And then again, one of the most important persons as far as the tab is concerned is the Chief Marketing Officer, Saurabh. He's again important for us because we are looking marketing support and all other things. So thank you very much, all three of you. Hope Vinay is also joining me. With this, I'll leave the forum to the CEO, Mr. G. Pradeep Kumar, with a request to take it for valuable and colleagues back in India. Thank you very much, and let's join Pradeep.
Thank you, Mudit, for that warm welcome and wonderful introduction. And once again, good morning and good afternoon, depending on where you are sitting today. Thank you all for joining us today in this session. Obviously, we are going through one of the most difficult times in living memory, and definitely for our generation. So there is unprecedented human tragedy that is happening across the world. Some countries are relatively better off. Some countries are facing a more difficult time as we speak. But as Indians, obviously, we are very concerned about what's happening in India, and it's a very, very difficult situation. So I do hope that all of you, wherever you are, keeping safe. Your families, people close to you, are doing well. And the most important thing at this stage is to focus on survival. Take care of yourself and people close to you. If we survive, I'm sure everything will recover. So it's important that uh, as people, as society, we come out of this. I have no doubt that we will come out of this. Okay, as a country, India will come out of this. The world will come out of this. But that is not to deny that we have a problem right now. So the fact that in 3 months or 6 months we'll be fine should not take our focus away from the issue today. So we have a problem to tackle today. So what we are advising all our stakeholders is keep yourself safe, get vaccinated as soon as you are able to. Many of you might have already done that, and continue to take all the precautions like wearing mask and washing your hands, social distancing, etc. It's we will overcome this absolutely, but it really requires a lot of effort from our side to tide over this. Having said that, while there is a human crisis, on the economic side, life needs to go on as well. Life doesn't come to a stop, because we also need to think about when we come out of this crisis, how do we take things forward? What does the future hold for us? So the economic well-being is also important. It may not be top of the agenda, top of the mind today to a lot of people, which is quite understandable. Even we are concerned more about the mental, physical well-being right now. But we also need to look ahead and see what the future holds for us from an economic point of view. And in these difficult times, what is the best thing that we can do with our investments? That's ultimately important. We need to make sure that financially also we are in good shape for our long-term well-being. Because even in a crisis, especially, we have seen the importance of being financially secure. In a crisis, it really comes out, the importance of being financially secure. The stock market obviously has had a wonderful run in the last 1 year or so, and we have one of the best people in the business to talk about that in greater detail, which is my colleague Vinay Pahadia. So a word about Vinay. As Mudit mentioned, yes, he has a lot of experience in the industry, but also he is known in the industry for being highly process oriented. So as Union Mutual Fund also, ever since he joined, we have become extremely process oriented. Every fund house will have a process, but the difference is that we have a robust process and we don't deviate from that at all. So Vinay is largely responsible for that. His track record with Union Mutual Fund and even before joining Union Mutual Fund speaks for itself. One of the most outstanding and consistent track records in the industry. We place a lot of importance on consistency, because rather than being top quartile for 3 months and then going to the bottom, we would prefer to be just above average on a consistent basis, because we believe that if we can be consistently above average over a long term, our funds will be right at the top, which we are currently seeing also in most of the categories. So that's very important. Why we focus on the process? Because process is the only thing which is in our control. You see, we cannot promise what the returns will be from the market. Nobody knows. We cannot promise what our rank will be among our competition. Okay, but what we can promise is that we have a process for selecting securities. We have a process for creating a portfolio for each fund. We have a process for managing our risk in each fund, and we will not deviate from that, because that is the only thing which we can keep on doing day after day. Now, we are not a fund house that depends on individual brilliance. Our team is definitely brilliant, but we depend on the process for results. Otherwise, it will be like, some of the very famous cricketers, a batsman, if he's in good form one day, he'll hit a century, and next day he may go out for a duck. We can't do that in investments. We need consistency, which is something that we are focusing on. Union Mutual Fund, as Mudit mentioned in his introduction, is sponsored by two highly reputed institutions, Union Bank of India, with more than 9,000 branches and a strong balance sheet, and Daiichi Life, which is one of the largest insurance companies coming out of Japan. They also have a strong presence in the asset management space. So Daiichi Life holds effectively 40% stake in our company. So we are sponsored by two, very large and reputed organizations. We are a profit-making company for many years now. Our assets under management is getting close to 6,000 crores. But importantly, the bulk of our assets come from individuals and high net worth individuals and retail. Close to 5,000 crores comes from that segment. We have more than 1 lakh unique investors with us. We have more than 2.5 lakh folios with us. We have about 17 products spread across different categories, and practically almost all of them have been doing well in their respective categories. So today, we will talk about, Vinay will give you an outline about, his view on the market and different sectors, and also how we, do the process. One thing, I would like to state upfront is that under SEBI regulations, we are not allowed to discuss individual stocks. So you must excuse us from that discussion. But otherwise, market sectors, I'm sure Vinay will be happy to discuss. Mudit has been a friend for more than 30 years. We have worked closely together, and we have huge respect for each other. So when the opportunity came for tying up with a bank like BBK, which itself is a very very reputed and very old bank, but the presence of Mudit and his team really gives us a lot of comfort that a good set of clients who are knowledgeable and genuinely long term will be looking at our funds. I know that a lot of institutions, a lot of mutual funds in India have approached BBK for tying up. So I'm grateful to Mudit and team BBK for choosing Union Mutual Fund. We really respect that. And I'm very confident that together we will be able to bring a lot of value to the customers of BBK in terms of funds which are true to label. Why do I say true to label? Because it's important. When you buy a small cap fund from Union Mutual Fund, you will actually get small cap exposure. You will not get multi cap exposure. When you buy a large cap fund, our large cap fund will be mostly large cap. There may be a little bit of mid cap, but we will not put small cap stocks in our large cap fund. Okay, we don't take what are the things that we don't do. That is very important. So we don't play momentum. So the flavor of the month is not something that we do. We have a very different approach, which when I will elaborate. So in a momentum market, we may actually underperform, which is expected because we don't play momentum. We don't try to time the market. We don't take cash calls. So our pure equity funds are almost always fully invested in equity. Our view is that people have invested in our funds to get equity exposure. So we ourselves claim that timing the market is difficult. So we are not going to do that. So that is it. We go largely by fundamental analysis. So we are not driving our funds. We are not managing our money based on technical analysis. Okay, it's not that we don't understand that. We do look at that, but that's not what drives our investment process and philosophy. So this is the way we manage our funds. So this is a value that we bring to the table. And with that introduction, I would now like to invite my colleague Vinay Pahadia to give you his views on the market sectors and how we manage funds, etc. And if there are questions, I'll be quite happy to come back at the end. Thank you once again.
Uh, uh, Thank you, Pradeep. And thank you to the entire team of BBK for inviting us for this talk. So, as Pradeep highlighted about our fund house uh, USP being a differentiated fund house which follows its investment process in both letter and spirit, I think we would want to be known as a fund house which is very consistent, which follows a system and process. And the objective of this is that the outcomes or the performance becomes much more repeatable. If the performance is driven by uh, uh, an individual, it will be more in the form of an art. But when it is driven by an investment process, it becomes significantly the outcomes become significantly a result of the science. And as we all know, science is definite, it is predictable, it is repeatable, etc. Our objective at the fund house is to ensure that we infuse science into the art of investing, make it as much scientific as possible, and reduce as much of human intervention or human errors as possible to make it much more driven by process. And that is what the USP of Union Mutual Fund is all about. What I intend to do is, in a very short span of time, I would want to briefly talk about our investment process, then talk about our market outlook. So our investment process is pretty straightforward. It starts with our investment philosophy, which is divided into two parts: stock selection and portfolio construction. Stock selection philosophy is pretty straightforward. We believe in fundamental analysis, and we believe that stock prices track intrinsic values over a long period of time. Hence, the endeavor of the investment team should be to understand what is the fair value of companies, how is the fair value growing, and third is what is the margin of safety towards this fair value. So that's the broad philosophy as far as stock selection is concerned, and the philosophy as far as portfolio construction is concerned is once again straightforward. We want to create portfolios which are true to label, follow the mandate in both letter and spirit. So that's the philosophy. How do we practice this philosophy using our systems and processes? And what are these systems? So once again, the investment process is divided into two parts: stock selection, portfolio construction. Stock selection is the responsibility, construction responsibility predominantly lies with the fund management team or the fund managers. Stock selection, it starts with it's a two-step process. We start with the investment universe, which consists of all companies more than 500 crores in market capitalization. So as we speak, there are about 1,000 odd companies which satisfy this criteria. So this is the set of companies from which we identify companies which can come in our fund house universe. So fund house universe is a subset of the investment universe. The fund house universe is a small set of companies, about 200 companies, which are available for investment for the fund management team in constructing any of the funds. So each and every stock which is present in the fund house universe is a stock which is available to buy. Means there is an enabling provision to buy it, which also means that stocks which are not within the fund house universe cannot be bought by any of the funds. So this is the way in which the exclusion and inclusion is practiced. Fund house universe is constructed using our BMV filter, which means we want to buy good businesses run by good managements available at reasonable valuations. Once we get these companies, we then segment them into two parts. This is the second step. We segment them into. So how do we go about selecting stocks? So when we talk about this BMV filter, I'm sure a lot of people do this, right? No one will go economical valuations, right? But the difference here lies in the process which we practice in identifying and putting in place these steps. So what is the process? When we want to identify a good business, we look at both quantitative and qualitative aspects. The quantitative aspects are very facts driven. They are driven by history, the track record of the business. There are various ratios and scores which we have internally developed, which help us understand and differentiate a good business and bad business. For example, a good business has to have a long-term future sustainably high ROE. So there are three things: high returns on equity over a long period of time, and it should be sustainable. All three aspects are crucial for it to qualify as a good business. Then we have similarly, when we are identifying good management. Now, identification of good management is not dependent on me or one of my fund managers meeting the company's management and deciding that based on the body language, I like the CEO. The CEO was very forthcoming, very energetic, and very excited about the future. Absolutely not. This is not the way in which we identify managements. We have a very cold-blooded way of identifying managements, good or bad. We look at history, track record, and there are a whole host of checklists which we look at before initiating on any company. These checklists are the pledge data from the company, like managerial remuneration, like related party transactions, like what they have said in the past in the annual reports and what they have delivered. Very crucial. We place a huge importance on history in past because we feel future is a continuation of the past. It is not something that suddenly it will appear. So we look at a lot of the past data and use it to formulate our view on the managements. So both these aspects, business quality and management quality, there is a huge amount of quantitative, factual data which is looked at, which is what differentiates us versus a lot of our peer group. There is less scope for qualitative intervention. There is a scope, but much limited scope compared to what we have seen in many other places. And this is how we have tried to implement a process which is scalable. If and only if a business is good quality and a management is a good management, will a company come in our fund house universe. Then we will judge its valuation using our own in-house developed proprietary fair value approach. This is a quantitative and little bit of qualitative approach, which helps us understand what would be the fair value of this company today, over the next 5 years, and over the next 10 years. Then we judge the price which we are paying for this company today to acquire this fair value over the next 5 years and 10 years, and then look at what is the potential return. We'll then compare all of the companies in our fund house universe across different sectors and look at what is the fair value growth and what is the potential fair value return. Utilize a lot of internal algorithms to help us identify which are the best and optimal portfolio which we can create using these companies. And this is how the entire process works to help us construct portfolios in different times. How does this help in managing various events? So a very striking example is what happened in the last 1 year. in the March, when we were grappling with the initial wave of the pandemic. At that time, all of us were struggling to understand the impact of the pandemic. The markets had tanked by about 30-35%. What we did as an analyst team is worst case and mild case impact of the pandemic. So the analyst team discussed and decided, let's say the worst case impact is 1 year of lockdown and what could be the impact on fair value, and mild case could be, let's say, 6 months of lockdown and what could be the impact on fair value. And then based on that, we worked backwards and realized that the overall impact on fair value for Nifty was just about 8 to 10%. And this is on the in a base case scenario. But the markets had corrected by more than 30%. And that made us believe that we were extremely attractive. Once again, we utilize something which is very proprietary, which is fair value of the markets. Most people tend to use earnings based approach. So they would use index P multiple or index EPS growth to judge whether markets are cheap or expensive. We have, as I said, developed certain in-house tools to help us judge whether markets are cheap or attractive. And based on this entire fair value approach, we judged that the market was cheap. And then we put out an extremely bold call that this is the best time. And we backed it up by doing the same thing in our asset allocation products, which is the Balanced Advantage Fund and the Equity Savings Fund, where our asset allocation was at the maximum level which it could have been based on. This is how broad stock selection part of our investment process works. On the portfolio construction side, this is the second step in investment process. It's very straightforward to construct portfolios which are true to mandate. Part of it, I think, now has been mandated by SEBI, so now people cannot deviate much. But even within the allowed deviations, I think it can lead to significantly good or bad outcomes for investors. Like, for example, as Pradeep highlighted, many multi-cap funds take cash calls. They think that, the markets are cheap, so let's invest 100%. And when markets are expensive, they have refrained from investing cash fully in the markets. Like, for example, they have 20% cash or 15% cash. We don't do that. We have a pretty straightforward approach. All the funds will remain fully invested. Only the Balanced Advantage Fund and the Equity Savings Fund have asset allocation as a communicated lever. In only these funds will increase or reduce their equity allocations at various points of time. So I won't go into too much details, but the idea is that each and every fund will be clearly true to mandate. A small cap investor will get small caps by letter and spirit. A large cap investor will get large caps, and so on and so forth. And this is how we have tried to incorporate these second investment philosophy of maintaining portfolios true to mandate. So I think that is the broad description of our investment process. I will now move on to our market outlook. Once again, I would make it short and crisp. Our market outlook is also driven by our investment process. We calculate the fair values of various companies in various sectors, look at how these sectors are growing or how these fair values are growing, and what is the price we are paying to acquire these fair values. Once again, an algorithm which we have developed in-house tells us which is the optimal approach to stocks and sectors. Based on this bottom-up approach, we then judge whether one sector is good or bad, or one segment which is large, mid, or small is good or bad. So now, purely from a market and macro perspective, we think the near term, we are a bit cautious because of valuation reasons. but over a medium to long term, we are very, very optimistic because of reasonably robust growth in fair values for Indian equities. So what are the key positives and negatives? Why are we optimistic and why are we cautious? So why are we optimistic? Even the near-term reason is global banks are extremely supportive. Each and every developed world central bank has pledged to keep the monetary policy easy for an extended period of time. They have expanded their balance sheets and have kept interest rates extremely low. As you are all aware, equities are long duration assets. Low interest rates fuel valuations for equities, and low interest rates are extremely attractive for equities, and hence this at least has remained one of the big drivers for equities, at least in the near term. The second is markets were expecting an extremely negative impact of the pandemic on economies. So as early as October, we were seeing expectations of about 14% impact on economy because of the ongoing pandemic. As we move forward, this reduced substantially to 7% impact. And when I'm talking about impact, it means the overall impact on GDP over FY21 and FY22 for India. So when the pandemic started, the expectations were for about 14% impact spread over a 2-year period. And this significantly kept on reducing because we kept on discovering that the impact is far lower than the initial assessment. And the lowest point was 7% impact. However, due to the second wave, we are once again seeing an worsening of this impact. We expect this will settle somewhere closer to 10% impact over FY21 and FY22. So 21 is already gone. Because of what we are seeing in 22, the cumulative impact could be about 10%. But still, that is better than the earlier assessment. The third big positive is the government support across various aspects. So the Indian government reduced corporate taxes. I think this has been completely forgotten by the investment community. But when we look at our companies' fair values, they get a material boost because of the lower taxation regime for newer manufacturing entities, for a lot of SOPs which the government has given. So, for example, the estimated tax rate for most of the companies is at about 25.5%. However, there is a substantially reduced corporate tax of 17.5% for companies which set up new manufacturing plants up till FY23. The rate, this 17.5% rate of tax is applicable perpetually, which means the fair values of goods which are produced from this is going to be substantially higher than the corporate values. I think this is completely ignored by the markets, and this is a reasonably good and important reason for us to remain optimistic. The second government measure has been innovative policies like production-linked incentive. Once again, a very innovative policy. This is likely to significantly increase domestic production for a lot of things. And at the same point of time, this is likely to give a boost to a lot of companies in the listed space in terms of their profits and revenues. So once again, this is an extremely positive thing. And the third is expectations of reasonably good monsoon. So which it will be a third consecutive year in which we will get a good monsoon based on the early projections which we have received. So I think these are broadly the big reasons why we think we should be optimistic. But why are we cautious? One of the top reasons is markets are still trading at a premium to their current fair values. So based on our internal estimates, the markets still remain at a reasonably good premium to their current fair values. And it simply means that we have borrowed some returns from the future. So our future returns will trail the underlying fair value growth by a few percentage points. Having said that, as I said, over a longer period of time, fair values have tracked nominal GDP growth. India's nominal GDP growth remains reasonably attractive, and even adjusted for currency, it promises a reasonably attractive potential return over a 5 to 10 year period. If one looks at it from a prism of long-term investment, returns from equities have clearly tracked their fair values, and this is based on some empirical studies which we have done. And hence, we remain extremely optimistic over a medium to long term about the prospects for Indian equities. In terms of capitalization, large, mid, and small, we remain neutral in terms of our allocation towards all the three capitalization, because the potential returns across all the three segments is almost similar. In terms of sectors, we are overweight sectors like telecom and IT, and also to some extent industrials, and we remain underweight sectors like utilities and consumer staples. Overall, we have been recommending asset allocation products to our investors because they are quite simple. So for a fund, for example, a fund like Balanced Advantage Fund, it is like fill it, shut it and forget it. People just invest in and leave the asset allocation to the fund managers, and that's it. So when the markets are expensive as they are today, Balanced Advantage Fund has reduced its equity allocation to 30%. And when markets were cheap, which is what the case was in April 2020, the allocation to equities had substantially increased to 80%. The overall objective is to produce a reasonably healthy returns while taking lower risk and producing a less volatile return outcome. So broadly, that's our views on the markets and our process. I would hand it over back to Saurabh and Pradeep. Thank you.
Hey, thanks, Vinay. So there are some questions which have come in on the link. Can we take them one by one?
Yes, please.
So, Vinay, the first question is from Mr. Prem Sagar from Aberdeen. Is there a possibility of several shake-up like 2008 due to the pandemic?
Is there a possibility of a shake-up?
Yeah, like 2008.
So I think maybe if the question is about whether should we worry about some big crash in the markets or something like that.
Correct.
I don't think so. See, unless and until there is a substantial increase in interest rates and a substantial increase in inflation, I think this kind of an outcome would not happen. The only reason one should worry, and that applies to any asset class, by the way, the only reason to worry is if you expect a substantial increase in inflation and interest rates anytime in the near future. I would say that that is one sort of a risk. Apart from that, we don't foresee any big risk for Indian equities in the near future, which can produce any sort of a big crash.
Okay.
Just to highlight one more point, the current pandemic, I think a lot of people are equating the current pandemic and the scenario with the sort of a crash which we experienced a year back. I think we need to remember the maximum potential impact on fair values, which we saw a year back, was about 8 to 10%. And this impact was also pretty high because no one knew what will be the extent of the lockdown, how much severe would be the lockdown, and what is the impact of this pandemic likely to be. Now, fast forward 1 year, we have 3 or 4 vaccines. We know for sure how much could be the lockdowns, and we know for sure what could be the impact on consumer demand, so on and so forth. So I think the impact on fair values is likely to be far, far smaller this time than the first wave. And hence, purely because of this, we do not expect the markets to significantly react.
Thanks, Vinay. The next question is Mr. Sunil from Delhi. And he wants to know if you have to look at some sectors for really long term. Are there any stories in India for a long term sector outlook which can be defining in years to come?
Yeah, so I think there are a lot of sector stories and individual company stories within individual with different sectors. So, and if you look at India, I think one of the attractions is that India is a high growth country. So, when you look at a high growth country, there are certain pockets which are growing extremely fast, some pockets which are growing at a steady, slow pace. Our objective is to identify which are those white spaces where the growth is potentially very large and is and is less tapped by the markets. So there are a lot of such themes. For example, there are themes in the small and medium enterprises space where companies are trying to tap the huge base of small and medium enterprises, trying to get them on board the internet, sell them software available as a service. Then there are spaces in the IT sector where companies are completely going in digital services, and this is resulting in a lot of opportunities even in the listed space. There are opportunities in the consumer discretionary basket where there are unique companies which are poised to grow fast because they are capturing the essence of e-commerce and organized retail. There are certain consumer staple retailers which are going on through internet and selling using innovative mediums like apps and WhatsApp, and these companies are seeing an exponential growth. So I think I can name companies and theme after theme which can explode in the next 5 to 10 years because the country's pattern of demand is changing. So on top of the higher growth of the country, there are certain structural changes which are happening, which is resulting in significantly higher growth in certain companies which are poised to take advantage of that. Our objective is to look around and remain invested in such opportunities because some of these opportunities are what we call as good businesses. People would tend to look them as sometimes as low ROE companies, but the way we look at ROE, returns on equity, is that what could be the return on equity of a company over a sustainably long period of time, which involves looking at capital turnover ratios, which involves looking at operating leverage and looking at the future to some extent. I think this is what we are trying to do in various of our opportunities, and I think clearly India has many such companies which are available.
Thanks, Vinay. The next question is for Mr. Menon from Anakulam. He wants to have a view on small and mid cap. So, is there good potential returns in the medium to long term if you are looking exposure to mid cap and small cap space?
I think absolutely. So the way to look at this entire capitalization curve, large, mid, and small, is that as you go down the cap curve, which is from large to mid to small, the rate of growth increases. So, for example, mid caps are expected to grow faster than large caps, and small caps are expected to grow faster than mid caps. Clearly, the level of growth and the period of growth clearly increases as you go down the cap curve. So, if you are invested in, let's say, smaller companies or small cap companies, I would say that if you are ready to remain invested for a period of more than 5 years, these companies should produce the highest potential returns along with higher volatility in returns. So returns will be volatile but will remain high. When you invest in mid caps, the returns will be slightly lower than small caps, but the volatility will be also be lower, and it will be the least in large caps. So I think the small and mid cap space clearly is having a large number of the opportunities which I highlighted in my previous answer, and hence our objective there is to capture those opportunities as much as possible. But we need to remember this space is more riskier. It has a higher volatility, but has a higher potential return over a 5 to 10 year period.
Vinay, do you have the same process for identifying the small cap shares also? Because you don't have
Absolutely.
any background or any historical analysis on these companies and management and all that. So, is there any difference in?
Yeah. So the way we look at small caps is that the level of due diligence also increases as you go down the cap curve.
Yeah.
So, for example, the level of due diligence required when you are analyzing a larger company is, if it is 1, then as you go and analyze a mid cap, it will be, let's say, 3. And when you analyze a small cap, it will be 10. So when we are investing in a small cap, one of the basic minimum criteria is that we need to have management access, which means the management should be available to answer our questions for all of the historical business actions which they have taken. And as I said, the level of due diligence required is far more. And also what we tend to do is we tend to diversify significantly in small caps. Because how much ever due diligence you do, the businesses are small and they're trying to grow big. So you can imagine it like startups. The most riskiest investment is in startup.
Yeah.
But the fatality rate of is also highest in startups.
Yeah.
So as it is like as you keep going up, it is like late stage investing in startups, and you are investing in them. You need a higher level of due diligence. You need a higher level of understanding of the industry. And very importantly, I would say that our internal system of fair value is far more suitable compared to our peer group for small and mid cap companies, because our peer group doesn't look at them like that. We have a system which, as I said, is very objective. It understands the importance of growth. So, for example, one of my peer group manager may be looking at one small company and one large company and looking at the P multiple and will say that, larger company is cheap, smaller company is expensive. So why to buy a small company? We'll go for the larger company. Our system actually gives importance to 4 factors when arriving at the fair value. It looks at returns on equity. It looks at earnings growth. It looks at risk-free rate of return. And finally, and very importantly, it looks at riskiness of an individual. I think most people would not be doing it simply because it involves a lot of and fundamental analysis to ensure we infuse science into the art of investing. And that is why it is very amenable to for small and
Thanks, Vinay. The next question we have is from Sachin from Bahrain. His question is that we are holding a lot number of stocks in the flexi cap fund. Is there any specific reason for that?
Sorry, Saurabh, I was not able to hear the question. Can you please repeat it?
Yeah, Vinay. So the next question is from Sachin from Bahrain. He's asking, our flexi cap has a large number of stocks. Is there any particular reason for having a larger number of stocks in flexi cap?
I'll add to that. The expense ratio in the flexi cap also is comparatively high. So can you just take both the queries together?
Yeah, sure.
So I will leave the expense ratio question to Pradeep and I will answer on why the number of stocks are more. So the way FlexiCap operates is that because of the way in which we operate, that is, we have a algorithm which helps us construct portfolio. The algorithm keeps telling us that the XYZ which we have included in the fund house universe needs to be in the portfolios in at times. and prune this tail. So I think once you see our portfolios maybe next month, you will realize that we do not have our portfolios and responding to the environment from time to time. And we do take notice that yes, the tail has increased substantially, and yes, we have reduced that tail. So you will see a smaller list of stocks in multi-cap.
Okay, so I think when we were
The
losing
expense
your...
ratio, I think sort of.
Yeah. I will
Sorry, actually,
respond to the. Yeah. Vinay, do you have another network you can connect to? Your voice is breaking.
Okay, I will try. I will try one more network.
In the meantime, on the expense ratio point that Mudit raised, you see what happens is most funds in the equity and hybrid space in India, they charge whatever is the maximum expense ratio allowed by SEBI. Okay, and we also do that. And when a fund size is small, the expense ratio is relatively high. And as the size of the fund goes up, your expense ratio comes down. So now our FlexiCap fund has crossed 500 crores. So its expense ratio has come down a bit, and it'll, continue to come down. But generally, all funds across the board charge, whatever is the maximum allowed by SEBI. But the point that you should look at is not the expense ratio. So you can have a fund with low expense ratio, but is not performing. What, as an investor, you should look at is how is the fund's NAV performing, because the NAV is after expenses. Now, you will be very happy to note that our FlexiCap fund over the last 1 year, 2 years, and 3 years is consistently a top quartile performer. So expense ratio, maybe 25 basis points here and there is not really what is going to make a difference. In an equity fund, if a good performing fund sometimes can give you 5% extra return compared to a fund with, sometimes lower expense ratio. So what you really need to look at in an actively managed fund is how is the performance post expenses. And on that count, our FlexiCap is doing extremely well. Expense ratio becomes a very important factor for a passively managed fund. So if you're looking at an ETF or an index fund, that fund, that it's not going to outperform the market at all. So your upside is limited. It will at best perform in line with the market. So a fund with lower expense ratio will naturally do better to that extent. In the case of an active fund, it is not such a big issue, because if the fund is performing well, your expense ratio really doesn't make a big difference.
Right.
Yeah. So Pradeep, I'll answer the first part on the tail of the fund. The Fed, you are right, Mudit, and the tail of the fund did really get bigger. The way it happens is that when we find a promising stock, the idea is to include it in the fund. But then the existing stocks are also very attractive. We find it difficult to find space from existing stocks. So we do add these smaller positions to make them a bigger position in the future. But what we have realized is that we need to keep pruning the fund's number of stocks from time to time to make it adequately diversified, not over diversified. And hence, you would observe that we have already done that in this month, and you would see that from next month onwards, we will have a normalized level of diversification.
Thanks, Vinay. We have one more question from Sachin from Bahrain. Recently, there is a good rally which happened in the metal stocks. And as a fund house, we have very little metal stocks in our portfolio. So what's our view on metal, and why we are not there? Why it is not there in the portfolio?
Yeah, so once again, it reflects our actions which back out our words. When we are discussing about investing in a good business, we need to think about the fact that how many good metal companies or commodities companies are available. And when we talk about good, it means there should be a sustainably high return on equity in these companies over a long period of time, which is foreseeable future. What we have noticed is that most metal companies will have bursts of good performance over a 10-15 year period, and after that they just keep sustaining. Sometimes, or in fact many times, they produce returns which are lower than their cost of equity. I think we do not have any special capability of forecasting metal prices. We do not have any special capability of forecasting the cycles. Our specialization lies in identifying structural trends, things which can do structurally well over a long period of time. We have less capability in timing the market or timing the cycle. So what we tend to do is we concentrate in our areas of specialization. We want to identify such good businesses and good companies and stay invested in them for a longer period of time. And hence our portfolio churn ratios are also lower. So I think that maybe answering your question, we are finding very limited good quality companies in the commodity space, and hence our exposure there is limited.
Thanks, Vinay. There is a question from Mr. Anthony from Riyadh. He wants to know again on the I know it's a repeat question, but if you can highlight again, it will help everyone. What are the sectors we are overweight on? And if you have to rate them in terms of high to low, if you can take everyone through that.
Okay.
In terms of growth potential.
So good. So our sector allocation is a result of stock selection. So if we are able to identify 5 good stocks in and allocate good weightage in one particular sector, that sector becomes overweight, and vice versa. If we are identifying less number of stocks in some sectors, those sectors becomes underweight. So today, our biggest overweight lies in the IT and telecom sector. Why IT? IT companies are companies which are seeing significantly higher and structurally improved level of demand. So while a lot of people argue, that IT companies have done well, don't you think that their valuations are high? We are saying that we don't look at just reported valuation. We look at what is the fair value of these companies and how has that changed. Over the last 1 year, while the IT stocks have done well, the fair values have actually increased more than the stock prices, which means the price to value has actually reduced compared to a year back. How does this value change? Value is not just reported 1 year EPS. Value is, as I said, dependent on 4 factors: returns on equity, earnings growth, risk-free rate of return, and riskiness of a company. Now, within the IT sector, 3 factors remain constant. The ROEs were already beyond 100%, so any further increase doesn't impact the companies. Riskiness of the businesses remains the same. Risk-free rate remains the same. What has changed in the entire equation is long-term potential earnings growth. The demand outlook has actually seen a shift of demand curve. Like in economics, remember, you used to see the aggregate demand shift on the right side. It just means that the demand curve has improved on a sustainable basis for these companies. And that's the reason the earnings growth has gone up substantially for these companies. IT decisions are no longer being taken just by the IT departments. They are being taken by the chief executive officers, by the corner office, to ensure survival and not just beautification of companies, customer contact, etc. It is actually led to survival, and hence this has led to increase in the IT spends on a sustainable basis. Clearly, that is visible in long-term guidance given by sector bellwether companies, and that is the reason why IT companies are big weightages in our portfolios. The second sector where we are overweight is telecom. Telecom in India especially is seeing a material amount of consolidation, and there is an inherent hidden pricing power with the existing 2 duopoly sector leaders in the telecom sector. These 2 sector leaders control almost the entire sector, especially the 4G market. There there is a hidden pricing power, which we are going to see unravel over the next 5 to 10 years. For example, one of the biggest market share owners has sold a material stake in his company and is now likely to see monetization of the subscribers in the next 3 to 5 year period. We think that markets may be underestimating the potential for monetization. And second reason why we are positive on telecom is because companies in this sector are likely to see many other forms of services which will come in and be given to offer to the consumers, which will increase their revenue per users. All of this will result only in an increase in ARPU because or the returns on equity, because the entire infrastructure and network cost is already being incurred. Anything which these companies offer or any increases in pricing is only likely to increase the profitability and the returns on equity, which according to our estimations, the market is not truly reflecting in the current prices. So we are overweight there. The second thing is, the third sector which we are overweight is industrials. Now there are a lot of, and these are not the typical capital goods companies. We have certain very unique capital goods companies which can take advantage of some of the policies of the government, like the production linked incentives, like robotics and automation, which are taking place in the country, and like the short cycle capex which is happening in the country. People are just looking at the broad capital expenditure demand and saying that the capex is declining, but the real micro level capex tells us that companies are changing in terms of their nature of capital expenditure. They're spending more on robotics, they're spending more on different types of technologies, and that is the reason our exposure is towards those kind of companies. We are underweight companies or sectors like utilities. Utilities appear very, very cheap. Why do we say appear? Because most people look at the existing earnings and look at the existing price and say, the PE multiple is low. But once again, a very important tool in our fair value toolkit is what are the 4 factors telling us. When we look at all of those factors, we realize that these companies are susceptible to significant disruption. These companies are susceptible to ROE declines, and hence the low PE multiple may be a mirage. Second sector where we are underweight is diametrically opposite. It is consumer staples. Here the companies are significantly expensive, even after considering all the 4 factors. So you will observe that our approach to the market is not very straight-jacketed, which is look at P multiples and look at whether it is cheap or expensive, but it looks at all the available information, bring it inside and look at what should be the worth of the companies, and then decide whether they are good or bad. And all of this is, of course, aligning along with my investor. So when I am talking to my investor, we always insist, please invest in our funds for more than 3 years. My fund management team has the same approach towards understanding and investing in companies. Explicitly, we don't want to invest for the next 1 year, 2 years. We want to invest for 3 years. And that is the reason we don't have commodity companies. Who knows what will happen to these prices in the next 3 years, right? So once again, our money is where our mouth is. We want to follow our investment process in both letter and spirit.
Thanks, Vinay. Pradeep, if you can take the next question, is that if we are bullish on IT and telecom over the long period, why don't we launch an IT and telecom fund, or is it in pipeline?
Yeah. You see, as a fund house, we do not really believe in launching sector funds. Okay, at least not narrow sector funds. Our belief is that investors typically don't make money in these funds. You see, we have experience of launching IT funds, pharma funds, infra funds, auto funds. I mean, we have seen a number of sector funds in the Indian market over the last, definitely in the last 20 odd years, I would say. Now, if you look at the history of those funds, how many investors really made money in that fund? You will be very hugely disappointed, I must say. Because typically what happens is mutual funds will launch a sector fund when the story is hot. You will come in, the story will run for some time, but no such story runs forever, right? There is an uptrend and there will also be a downtrend. Now, what happens is, people, no fund house really goes and tells the investor that you have made enough money in this sector fund. The story is over. Right now, we are not really seeing this running further. Please get out, or we are winding up the fund. Nobody tells this. So, as a result, at the peak, when people have made money, very few people sell. And then, most stories, they run out of steam, NAV goes down. And that is when investors typically look at it and say, oh my God, what's happening? This is going down. This is not such a great idea. And finally, they will sell at a very low price. So what matters to an investor is not the historical NAV. As a fund house, I can say that, yeah, you gave 10 rupees. Look at it, the 2 years back, it was 20 rupees. Fine. Today, when I am selling, what am I getting? This is the only thing that the investor is bothered about. The rest is all, hypothetical. It's all academic. So based on the investor behavior and the history of sector funds, we don't think that investors make money in it. We are not confident. So we will not launch such narrow sector funds in an open-ended way. Because see, there has to be a built-in mechanism where once you have made money, you get out. Because sector funds, in our view, are a tactical plays. They are not, you're part of your strategic investments. They are not part of your core portfolio. You can do a tactical play in a sector fund, go in, say that, there is a limited time available for this story. I can make some money in, out. That is a kind of thing with a sector fund. So, we don't see that opportunity right now. So unless we can find a large theme, a wide theme, which is sustainable over a longer period of time, we will not be launching, a narrow sector fund or a thematic fund, because we don't think you will make money out of it eventually. Okay. But look at, our flexi cap funds or, the broader funds. Any good sector will automatically be captured there. So if you invest in our flexi cap fund, you will get the benefit of investing in any sector that we think has good prospects. So today we think IT is a good story. Vinay is bullish, our team is bullish, and we have higher exposure to IT. But a narrow sector fund is not something that we recommend to our investors, frankly.
You are very true and well said.
I will also add one more aspect to this, that we have been seeing presence of good themes and stocks in different sectors. So what matters, especially in a country like India, is bottom-up stock picking and focus on special themes which are doing well, which can be present in multiple sectors.
Thanks, Vinay. Thanks, Pradeep. There's one more question from Mr. Jacob. What's the view on gold? Do we have a view on gold?
So I think we are not specialists in commodity. We have not done much research on gold. But generally, I think gold is like insurance for financial catastrophe. If you think, that all the central banks will further substantially expand their balance sheets and inflation will be substantial, then and all the currencies will depreciate, then all of these currencies depreciate against what? they will depreciate against gold, which means gold goes up and currencies go down. So I think that is the extreme scenario in which gold can do pretty well. But since gold doesn't have any earnings, nor does it have, straightforward demand and supply, which is more use based, it's more driven by investment activity, and hence it is difficult to pinpoint what should be the worth of gold. Hence, we do not have an official view on gold.
Right.
Thanks, Vinay. Mudit, we have covered all the questions which were there.
See, one question which is coming in my mind, like Vinay, you have told that you have been following a certain process for stock selection and portfolio creation. Now, one question which is coming in my mind is that ultimately it's a process. 99% it might get right, 1% has chances to go away also. So how frequent you analyze and introspect your processes, and how would you fine tune it in line with your experience or in line with the prospects in the market?
Yeah. So I think that's a very good question, Madhu. See, I think more than anything, the leaders of any organization need to be modest, especially on the investment side. They need to have this humility that, we can be wrong. And I think that is the way in which we approach the entire investment function. We do not think that we have a magic formula. We do not think that we are the best. What we always think is that we need to keep iterating. It's like Jeff Bezos says, you need to keep iterating. Keep thinking and experimenting with your process and see how it works. So we don't take too many big risks such that it can be fatal, but we do keep taking small risks to keep testing newer hypotheses within our investment process. Like, for example, should we look at 5-year fair value growth, or should we look at 10-year fair value growth? What is important? For example, how do we judge quality of management? Is there a way in which we can, using some algorithms, judge what is a good management? Is there some score which we can devise which helps us understand what is a good business? So we keep iterating that in the background on an ongoing basis, because the ultimate idea is to reduce human error. It doesn't mean we will let machine take over, but we want to ensure it's a fine balance between human and machines to get the best of both worlds.
Right.
And be modest and at all points of time.
Vinay, one question which is coming in my mind is that the last year, of course, you mentioned that the valuations were very attractive in August, September, when the market corrected almost 30-35%. Do you think that was the only criteria when the market took the other turn and reached at a peak? Or basically, it was liquidity driven when the manufacturing was hardly doing anything, service industry was highly affected, no industry, no sector was doing well. And we were seeing a lot of money coming into SIPs, mutual fund, even the share market, mainly from the retail and individual. Was it the liquidity driven because people were having no other avenues to put money, and whether that trend is likely to continue this year as well?
Yeah. So I think what we think is that markets are very, very smart, super smart. It is not driven by one or two or few people or few set of people. Like, for example, there was a saying in our markets that FIIs drive stock prices. That and now, as you rightly said, liquidity is given a lot of importance. But we think liquidity is like water. It will find its own place. Money will flow to the best available opportunity. World over, people who are investors are the smartest people you will ever meet. They will invest money over a period of time, which is going to give them the best returns. So generally, markets are efficient. And that is why, if I talked about being modest, you need to remember that markets are very smart. And from there, I can highlight that the reason why markets first fell and then went up sharply is because when it fell, it thought that the impact on companies and demand behavior could be catastrophic. When we were talking about a 10% impact on GDP, it could have been easily be 30% because we did not know. And that was the reason there was a knee-jerk impact the market had. But the reason subsequently and very gradually it started recovering was when this entire realization came in that maybe the impact is more smaller, maybe we are wrong, and maybe because the future may not be as bad as we are thinking. So it's a collective wisdom. So I think given the current interest rates, markets are trading at valuations which they should trade at. I would attribute the current returns and the volatility in markets purely because of the pandemic and less to liquidity.
So broadly, what we are talking about are the two risk factors. One is, as you have mentioned, the rise in the interest rate followed by rise in inflation. That is a global factor.
Yes.
And domestic, we can say if the second wave goes to third wave and all that, there will be some pressure on growth, on the earning potential. But as you are saying, this will be a time being. Pradeep has started his session that every night has seen it's the next morning. So we'll rely on trust on the processes, which will pick up the good stocks which have got long-term value in store, irrespective of the risk factors globally or domestically, and the fund will continue to be into that. Will be the endeavor to keep all the funds in the first quartile, and that's what, as a banker, as a distributor, we also look for the consistency. We don't believe in that a fund. We don't believe in your turnover ratio is very low. Our portfolio turnover ratio is also very low. We don't believe in switching over from one fund to another funds. So we also look and believe in the consistency in the fund. That's what our outlook is. Saurabh, have we covered all questions?
Yes, Mudit, we've covered all the questions.
So, Mudit, can I just add a general point?
Okay. Yes, please.
Not with respect to any particular sector, but it's about a behavior of investors that we have observed over the years. Even you might have observed it, because while everybody talks about long-term investment, very few people really understand what is long-term investment and what is the power of compounding. Okay, now just to illustrate this story or this principle. Okay, you take one of the good mutual funds in India, reasonably good mutual funds in India. Okay, if you had done a 10,000 rupee SIP for 10 years, you would have invested 12 lakh rupees, and in 10 years it would have grown to say about 24 lakh rupees. But if you had done it for 20 years, your investment would have been only double. Instead of 12 lakhs, you would have invested 24 lakhs. But the value of the investment today would be more than 2 crores. But, can you guess how many people have actually done 20-year SIPs in one fund? Very few. I don't think there are even 1,000 investors who have done that. Okay, because once they have made some money, people think of booking profits and, jumping to another fund or doing something else, trading, etc. And they lose out on the big opportunity. If you we have the best example of Warren Buffett, who is considered to be the most successful investor in human history. Now, Warren Buffett's net worth is more than $90 billion. The beauty is that 99% of this net worth of 90 billion came after he turned 50. He started investing at the age of 10, and I'm actually picking up from this book by Morgan Housel on the psychology of money. So he started investing at the age of 10, and by the age of 30, he had $1 million, and he was growing money at the rate of 22% per annum. If he retired at 60, like most people do, Warren Buffett would have retired with a corpus of close to $400 million, $389 million. A lot of money, great money. He could have enjoyed life tremendously afterwards, but we would not be talking about Warren Buffett today if he had retired at the age of 60. The point is, He stayed invested, he continued to invest, and he continued to grow money, which is why today he has $90 billion. So the point is, time is the biggest factor that allows you to make money, allows your money to grow. It is not a fund house or a fund manager or a distributor. You have to give time to your money to grow. You give time. I always say, in equity market, it's a market which gives you the most returns. The role of a fund manager is secondary. You stay invested in the market, even in the worst performing fund, you'll still make good money. You choose a good fund, a consistent fund house, you'll make more money. So please give time to your investments. Don't try to react to every development in the market. You look at what we have seen in the last 20 odd years. We had, the IT boom, tech boom, then the tech bust. We had 9/11. We had a big crash in Indian market in 2004 after the elections. Then in 2008, we had a big global financial crisis. We had, demon. We had various tightening and global developments. After all that, look at where our market is. We are at a historic high. People have made, at least 10 times the money. So please give time to your investments. Choose a good fund house, have a plan, and then stick to it, is what we would request you. Thank you.
Saurabh, you have been asking questions to everyone. One question to you. So suppose one of our customers wants to create a SIP portfolio of, say, 1 lakh rupees. How will you split the fund among your funds?
So I would, put 50% in flexi cap category, which is what I call the core part of the portfolio. So I consider flexi cap as core part of any portfolio. So I'll put 50% over there. And the rest 50%, which will be the long-term SIP, really long-term SIPs for 20 years, I would choose nothing but the small cap and the mid cap. Right. Yeah. Because look, small cap has a potential to give the highest return over a long period of time. While in the short term, we may look at 3 years, 5 years. But if you're looking at a 20-year journey, there's nothing better than the small cap fund. But the plan is to stick with the 20-year journey. Like Pradeep said, there are very few people who do the 20 years. But people who do that, they really create wealth. And small cap is a fantastic way to create wealth over a long period. So my answer in short is 50% flexi cap and 50% combination of mid and small cap is what I'll do.
Another question to you is that Pradeep has smartly answered the question about expense ratio and fully agreed to that. But my question is, if expense ratio is 1% less, my investors will get 1% more. So far, your 80% portfolio is retail. Suppose if you have more corporates coming in your portfolio, increasing the AUM, the expense ratio would automatically come down.
Correct.
So far, the corporate has not been part of this portfolio. Is there any specific reason where you have got Union Bank with you with 600 plus branches? They have got so many of corporates in their house.
So typically, Mudit, if you look at the Indian investment scenario, most of the corporates are restricted on the debt side of the business, predominantly liquid and your debt funds. There are very few corporates who are taking aggressive call on the equity side of the portfolio. That's a typical allocation which happens in India. So bulk of the money from our larger corporates are going into debt. Yes, there are smaller corporates and partnership firms who are investing into our funds also, but they are not typically large corporates. So that's the retail. So equity business, if you look at it, the typical application size in India for any fund house, average application size is 2.5-3 lakhs. That's the nature of business retail in India for equity.
All right. Pradeep, 2 questions to you. Lastly, sorry. One is, are you planning to launch any PMS? And what was the other question? I forgot. This is the question. PMS?
Yeah. So, PMS is something that we are looking at. Again, it's a kind of we need to be at a particular stage in our evolution to be doing a PMS. And our thinking is that we should do a PMS when we have a differentiated strategy to offer, not see, anything that can be done on a mutual fund platform is better done on a mutual fund platform, because your expenses are low, and your taxation is a lot more favorable on mutual funds. So investors will actually make more money. Like for like, if you compare, you will make more money in a mutual fund platform. So to do a PMS, we need to come up with a differentiated strategy, a strategy that cannot be executed on the mutual fund platform. So we are working on a few ideas. At the moment, no, we don't have anything immediately, but it's very much part of our business plan. So at some stage in the future, perhaps next year, we could be looking at it.
We would be looking at that. Vinay, one question to you as well. Last year, there are certain funds who have done well by investing in the overseas stocks. Are you planning to add to those stocks in your portfolio?
And so while our existing funds are funds which have a pure mandate to invest in Indian equities. So by mandate, we cannot invest outside Indian equities. So if we have to actually take advantage of foreign equities, we will have to launch a separate fund on which I would ask Pradeep to comment on.
Nice.
Yeah, so we are working on a fund which will invest in foreign securities. So I think maybe in the next 3 to 6 months, we should be able to hit the market with that fund. We don't want to mix up our domestic equity with foreign equity, because then it goes into a different risk profile altogether. Okay, so which we believe is not fair to people who are already invested with us. So a new fund which invests only in foreign equity or a mix of both Indian and foreign equity is possible, but we don't want to really mess around with our existing funds.
When this corporate taxation which you have mentioned last year, corporate have got benefited, but hardly anything is passed on to the retail side. With the result, the demand has not picked up, and we are seeing the same thing happening this year as well.
Correct. So see, I think it's a very thin line that how much of pricing power do you have? So there are when we talk about good companies, the objective is to find out those companies which can retain value as much as possible. So customer is not paying you for a. So for example, I'll give you an example. If I'm let's say a scooter company who wants to set up an electric vehicle factory, and I want to set up a world-class factory which has the latest robots. I don't want human intervention. What would I do? I will go to the top 2 or 3 manufacturers and invite quotes, and then based on technical competence and quality of the product, I will give business to whoever is good. Here, pricing is far less important than product, technology, and quality. Similarly, in various other companies which we have invested in, so I can give you examples after examples where pricing is a very small lever. The bigger lever is the value which customer is getting, which is the perception of the customer. And it is in these companies who can see a substantial retention of the value. See, ultimately, otherwise, in economics, if we see a perfectly competitive business is one which always generates returns on equity equivalent to cost of equity, right? Because if you earn more, there will be more companies who will enter the business and they will drive down your ROEs. Perfect example is construction companies, right?
Yeah.
So we want to avoid, and some of the commodity companies also fall in this category. We want to avoid such companies. We are invested in companies which have our classic moats. Most abused word, but we have tried to incorporate this in our process. Companies which have competitive advantage and which can retain value. And hence, I think our portfolio companies are clearly benefiting out of corporate taxation reduction.
Vinay, why are you not overweight on pharmaceuticals?
So,
which is the buzzword these days?
Yeah, so we actually were significantly overweight pharma when the pandemic struck us, not because we thought, we will have some problems, but because at that point of time, pharmaceutical sector was extremely cheap relative to the value offered. Once again, not cheap in the P multiple terms, but cheap in price to value. Being companies and getting possible valuation for that going to generate. So at that point of time, we had a substantially higher allocation to pharma.
When I sorry, yeah. I think there was a break. So you said
okay.
We invested in pharma. We were overweight when the pandemic struck us, not because of valuation. That's where we lost you.
Yeah. So what I will do is I'll stop my video and it will give a clearer audio. So we were invested in pharmaceuticals aggressively when we entered the pandemic because they were very, very cheap in terms of price to value. So the prices were extremely attractive for the potential future returns. So at that time, we were meaningfully overweight. But what we observed is over a 6-month period, the prices of these companies appreciated far more than their fair values, which is
no, but the earning potential.
So IT sector also saw. So exactly, earnings potential has gone up, but the prices have gone up more than the earnings potential, and hence we are not significantly overweight pharma. We are equal weight pharma,
you are
especially
underweight
in companies which are on the CRAMS side of the business. So in some of the funds, you will observe it is underweight because it's the way in which the JIC sector is classified. But on an economic basis, we are equal weight in most pharma companies.
See, the thing
some
is,
some pharma companies are masquerading as pharma.
Right. Anyway. Right. So that is all from my side. I hope it's a very, very enlightening and a long session. And thank you very much. We'll be definitely looking. And one thing is, Saurabh, is whenever the PMS is launched, we will be definitely looking at it and we can have a separate session on that.
Sure.
And thank you very much, my colleagues in India and Bahrain and the customers all over globe. I don't know from where they have logged in. Thank you very much, Pradeep, Saurabh, Vinay, and Ashay for giving us BBK opportunity to present this. Let's have this, I'll not say frequent, but maybe more once in 3 months, 4 months, 6 months, whenever there's uptime, it will be beneficial for both of us.
Excellent.
Thank you very much.
Thank you, Mudid. We would certainly be happy to interact with you and your investors anytime you wish to.
Thank you.
Okay.
Thank you.
Bye-bye.
Bye-bye.
Bye.